So look, let's bring it to the final one here, which I think is a really popular one. Or at least there's a lot of anecdotes here. And this has to do, the headline you have here, tech companies reducing office footprint. But it really has to do about commercial real estate, urban commercial real estate. We saw a news item, some building. I'm going to get this wrong, maybe in St. Louis or Oklahoma, sold for 200 million and just sold for 20 million or 6 million,
Yeah.
some crazy numbers. You're seeing, you have the number right here, San Francisco office vacancy rate at 36.7% in Q1, down from 3.6%. I think with everyone still, even though it's 15 years later, feeling the scars of the housing crisis, this is getting a lot of mind share in the media and a lot of people talking about it. Look, what's your take here, Gary?
So this has been a continuing series. I think every week on the 5 things for the past month or two, we've been talking about issues in commercial real estate. And you've correctly pointed out that doesn't mean we're going to have a 2008 style disaster, and that could certainly be the case. And I agree that there's less leverage in the system now than there was then. With that said, there are a couple things going on. First of all, the tech firms pre-COVID were actually buying or renting office space defensively. They were intentionally taking on more space than they needed because they thought they would grow forever. Not only has that stopped, it's actually reversed. And the reason for the reversal is, one, they have fired tens of thousands of employees. They've reduced headcount. And two, work from home, work from anywhere. And tech employees are probably better equipped to work from home, work from anywhere than any large company employees in other fields. Technology it lends itself really well to being able to work from Uruguay. And I do that. In finance, I work from everywhere. I work from many different countries. But that reversal here, where we're looking at vacancies in San Francisco up 10x, that is a huge problem. And I can assure you, a 3.6% vacancy rate in 2019, they're thinking fantastic. This is amazing. At 36, 37%, you end up losing your equity value. Keys end up being sent back to the mortgage holders. So, the takeaway on this, I think, is to acknowledge on the positive side, Enrique's point, which is there's probably less leverage in the commercial side of the business now than there was in the housing market in 2008. But on the negative side, in 2008, housing demand didn't disappear, right? People, valuations went down, and a lot of people handed their keys back to the bank. But we didn't lose people, and the people who existed didn't lose an interest in having a place to live. That's not happening on the office side. The demand for office space is decreasing, and it will be many, many years before it reaches 2019 levels again. And in the fight between boomer age bosses who want people to be in the office, FaceTime, be physically present, and the younger push toward work from anywhere, it's very clear the work from anywhere people are winning that battle. Not every time, not in every space, but it's going to be years, maybe decades before the demand for office space is what it was. And that we didn't have happen in 2008. In 2007 and 2009, the valuations of the housing market moved, but the number of people who wanted to be in a house was exactly the same. That's not the case with office space. And I think that demand is, if not permanently impaired, it's impaired for the foreseeable future.
Yeah, I agree with you on all of that. I think that where, so I'll say this a different way. I believe that the demand for Class B and C office space in urban areas, as well as suburban areas, is permanently impaired. Now, what does Class B and C mean? Older buildings, just not as new, not as nice, it's just kind of the second tier. Imagine if we were to do the housing example, it's the houses that are in the not as nice neighborhoods and that are a little bit older, et cetera. And I don't think it's ever going to recover. The question is for me, and you're not saying this, but the media is saying this, and a lot of talking heads are saying is, what is the materiality? In the housing crisis, we had millions, tens of millions of homes that were involved in that process. And there were thousands of lenders. It was a very complex ecosystem. It made up 10, 20, 30% of the housing stock. The reality is the truly impaired, and I'm going to tell you where I'm getting my information from here in a second, the truly impaired percentage by square footage in North America is maybe 5, maybe 10%. The CEO of SL Green, that's what I was looking at. When I'm looking over here, I'm looking at my Bloomberg, just so everyone knows. I'm not checking the sports scores, the Yankee score, but SL Green was CEO was on, and he's like, they're at their 2019 levels. So I think that I agree with everything. I don't think it gets better. I think the materiality, though, is being misjudged. We always there's old Wall Street saying, we're always fighting the last war. The last war in housing crisis was a huge swath of the economy, affecting tens of millions of people and millions of pieces of property and thousands of lenders. This isn't. It's a relatively narrow swath. And this comes to the final point, and I think this will resonate with you. The markets are fixed. The markets are rigged. We wrote a report about this a couple months ago. They're rigged to survive. And so you have a situation where these buildings, they clearly are worth in the open market less than much less than where the loan is. But the bank doesn't want the loan. The person who owns the building doesn't want to put the loan out there. And there's no reason they really have to. And the government doesn't want it to happen. So you basically have all of the involved parties. The only thing that exists is a contract. And that contract can be renegotiated. It needs to be renegotiated in the context of bank lending ratios. But I think what you're going to see, I think this is a relatively minor problem for the overall economy. And by the way, I think I am absolutely confident that they're already working on it. That the Federal Reserve, and again, I'm not here to make judgments. I'm just here to tell you how things work. The Federal Reserve is putting together a group of banks, a group of lenders, et cetera, to act as a backstop to take on the worst of these loans. They'll loosen the bank lending ratios. I know, and I'll tell you where I'm getting all this from is, I went to school at the University of Pennsylvania. I have a half a dozen buddies who run real estate funds. One of them runs one of the largest family office real estate offices in New York City. They're like the number 3 real estate holder. Another one of them runs like a $30 billion fund. They're not bearish at all. They're literally sitting there saying, we're sitting on tens of billions of dollars waiting for these buildings to clear. They were bidding on the Silicon Valley Bank assets, et cetera. So that's a long way of saying, I think these are real problems, but there's a lot of things that can take down this economy. I do not think this is going to be what it is. And again, that's not what you were saying, but that's what the media is saying. And this is where we have at HX Research a very contrarian take. And again, when I say contrarian take, it's not because I'm so friggin' smart, but I know a lot of really smart guys that are doing a lot of business in these areas, and I listen to them. And this is what we're hearing from them. So a real concern, but there's bigger fish to fry. So
I agree with you on this. I don't think that commercial real estate takes down the economy. I don't think it creates a widespread crisis. But what could really create a problem is if the government bails out the lenders again. If they bail out the banks again, people are going to be angry, right? Because, in general, Americans tend to have short memories, but everybody of a certain age remembers how angry everyone was in 2008 when the banks got bailed out. They do that again, just 16 years later, I think people are going to be angry, and that could lead to real issues.
Can I give you one thing to think about, though, that
Yeah.
people aren't talking about? Federal Reserve's got 500 basis points of rate cuts in front of it at some point. So this will all end badly at some point. But remember, you raise rates by 500 basis points. It means you got 500 basis points of rate cuts and stimulus to come at some point. I'm not some Pollyanna, but there's another side to that coin. So I think that you're absolutely true, and I think it builds to a crescendo through time. But it's the reality of what happens in people's anger and perceptions about it, and when that meets the reality. And I'll say this one last thing: people got to show it in their voting. People aren't voting for politicians that are going to do the things that you're saying they should be doing or that they want them to do. They're voting for the status quo, and the status quo is going to be to bail these banks out and to cut interest rates down to zero again. And until we see a real change in the willingness of voting to change that, I think we're going to continue to see more of the same.
All right. So Enrique, it sounds like your view is that higher for longer means higher for longer for inflation. So the question I've got for everyone watching this: is your portfolio prepared for higher inflation? If not, give us a call or check out Enrique's research at HX Research. For people who are interested, how can they find you?
The best place, you can follow me on Twitter at Enrique Abeyta, ENRIQUE ABEYTA, and at HX_research. But the really best place, we have a free daily email, comes out every day, several pages, daily.hxresearch.net, daily.hxresearch.net. You can sign up for free and get access to a ton of our stuff.
I read it every morning. It's a great piece. It's I make sure I've read everything you've written before the market opens.
That's why we publish it at 8 a.m.
Perfect. All right. Well, we will put a link to your to HX Research in the comments here. Sorry, in the description. For everyone watching this, thank you so much. We know your time is valuable. Really appreciate it. If you like this video, feel free to like and subscribe. We'd love to keep producing more of these for you, and wishing all of you a good week. Look forward to seeing you next week with a new 5 things. And Enrique, thank you so much for being the guest host. Really appreciate it.
Appreciate the opportunity, Gary.